So for those who may be new to InCorp Advisory, we're a specialist firm focused on helping growth stage companies navigate the complexities of growth. So mainly focusing on R&D, structuring, tax and business advisory, working with a lot of sort of tech startups, scale-ups, and really established companies who are just looking for that next stage of growth. So tonight we're really just exploring what it means to truly be growth ready in this competitive landscape that we're in at the moment. And we've got a panel of 4 very interesting, exciting people who will talk about really having the right stuff to be growth ready in this environment. I'll pass to the panel now for introductions. So we'll start with Alex.
Thanks, Ben. So I'm Alex, co-founder of Kashcade. We're Australia's fastest R&D lender. We've built a business basically bringing forward the R&D tax incentive for a lot of early stage and growth stage companies. So we work with hundreds of companies like yours every year through all kinds of industries. And basically we help them get the working capital to get them through and achieve what they need to do instead of waiting around and being choked on capital.
Yeah. All right, so I'm Glenn. I'm a director here at InCorp in the tax and advisory team. I've been at the firm for 8 years. I've got a lot of mutual clients with Bailey and the R&D team. So by way of that, I've got a lot of startup clients, high growth clients, and so sort of help them through that journey.
Hi everyone, I'm Sammy. I'm an associate at Tidal Ventures. We're an early stage VC fund, so backing businesses anywhere north of around 200,000 in recurring revenue. We come in with check size of around 1.5 to 3 mil and really help our companies scale from that seed to Series A stage.
Thank you. Thanks. Hi everybody. I'm Jonathan, founder of Andiron Group. So if these guys are more of the numbers guys, I'm more of the word guy. We use communications to scale and grow businesses, and communications means everything from PR, thought leadership, partner comms, investor comms. So I'm just glad to be here.
Thanks, everyone. So to begin the discussion, it would be good to just start with the foundations of being growth ready. So everything from saying having the right structure in place to enable growth. And Sammy, I might start with you here. So from an investor's perspective, what are the most common red flags that you see when assessing, say, a founder or a potential investment for you?
Yeah, it's a really good question. I'd say I'd bucket it into things that are pretty structural issues, and then the second being things that you can change and have a bit more control over. In terms of structural issues, I feel like cap tables are often one of the biggest reasons that we won't progress with a deal pretty early on. You often find a business may have raised a bit too much capital for where they were at an earlier stage, which means that for us, looking at the investment a little bit later on, it makes it a bit untenable. The founder might be way too diluted for us to come in with terms that we think are reasonable for the stage that we come in. So that's part of it. And then I'd say the second part of it is a few things around, maybe not really acknowledging competitors in the market, not really having a good sense of your positioning, not having enough clarity around the vision that you're putting forward. I think those are often things that'll turn us off as well.
And is that something that you see pretty often?
Yeah, I'd say so. I'd say if things don't often progress past a first conversation, those are probably most common reasons why.
Okay. What about you, Glenn? So from an accounting or tax perspective, what mistakes do you often see founders making in terms of like structuring that affects long-term outcomes for them?
Yeah, I'll probably put it into 2 buckets. I'd say you've got your founder bucket and you've got your corporate or commercial bucket, right? So from a founder perspective, using examples I've had in the last couple of months, I've had a client come to me, or a potential new client come to me saying that they're in the process of raising capital, but they realise that they're holding the shares in this company in the wrong investment vehicle. So investing it via an individual as opposed to maybe a more tax-effective structure like a trust, and it becomes challenging at that point to do the restructure for them at a tax effective value. So they would want to change shareholders at a low val to avoid tax, but then turning around a month later and raising money at a higher value. So it creates problems from that perspective. So if you could get it right in the first place and get the right advice at the beginning of the process, that would be a lot better. From a commercial perspective, I see, and it'll be interesting, Sammy, to see if this is an influence on your decision making as well, where the client has the IP and the operations all being performed and held by the same entity, whereas it might be more efficient and from a asset protection perspective rather than a tax perspective to have them separated. Fixing those problems, it's not insurmountable, but it just comes at a time, well, you've got to incur costs to fix it at a time where you need to move quickly to secure the investments.
Excellent. So Alex, maybe to hear from you now, how do capital planning mistakes like unrealistic projections or last minute raises affect a startup's ability to grow?
Yeah, I think they, I can speak without. Can everyone hear me? Yeah, cool. Sharad, you can hear me? Cool. So I think proactivity is often one of the most common ingredients for long-term success with companies. Those that react and leave it very late to do so, they find themselves in a tight spot. When you're in a tight spot, you're left with limited options. When you're left with limited options, you have no ability to negotiate, leverage any sort of position you have, and so you either end up raising capital on very poor terms, whether it's costly through equity or debt or whatever it might be, inflexible, and similarly, they can often not raise the capital they need to actually raise to sustain the business through to the next stage. So that can become even more problematic. So those who really think ahead of time, and despite us not having $0 in the bank account, we can see that in kind of 6 months' time we will. And so addressing that early is really important and avoids that really kind of downside case. On the other side, companies that project really, really bullish cases, they see themselves growing more than 100% year on year when they haven't demonstrated that or anywhere near that in the past. It actually instills probably an element of cynicism or skepticism when you actually look at the company and the founders, and it's a representation of perhaps how trustworthy they are or how likely they are to actually be realistic and be able to operate their business in a realistic way. And again, from a capital provider side, you want to have full confidence in the people you're providing the money to. It's not just this faceless company. These are the people that are operating that company and will therefore impact what actually happens to that capital. And so that can be really damning to them as well. It's really hard, as a founder myself, I can speak to the optimism you have to have in your company. But just knowing that when you're going to a capital provider, they will look at it with a healthy level of skepticism, and really those people are finance professionals as well, and so they probably would have seen more scenarios that are comparable to yours and know what's realistic. And so we definitely encourage people to temper that and just be as realistic as possible. Some people actually use kind of 3 scenarios to model these things, so like a base case, a bull case, and a bear case, which also demonstrates that you can think about different scenarios and how you'll react to that. I think that instills a lot of confidence, at least from a lender's perspective. I'd be interested to hear whether that's the same from Sammy's perspective. But yeah, I would say those are the 2 big ones.
So Jonathan, as a founder yourself, does any of this resonate, or is any of these things something that you when you were founding your business, you made a mistake that you want to share right early on?
I was going to say that I'm kind of in a unique position here tonight because I feel like I'm learning and I think a lot of people in the audience are, about the sort of the financial back, and I know some of it, right? But I'm also learning what this side looks like, because the communication side kind of stands apart from that. And I was thinking in response to, Glenn, you were talking about how things change in the back end and can get very complicated. And I know from a business point of view, they get quite complicated. And my main message, I guess, tonight, I was thinking, what's the value I could bring? It's that the communication message, it can actually be robust and sit on top of that and doesn't have to constantly alter and shouldn't necessarily alter depending on what business structures, financing you do, et cetera. But also going to your point, Alex, about changes of narrative, in terms of, say, overly bullish, et cetera. That's critical. I think realism in your story and in your communications to the public, either PR or investors or shareholders or even internally, it's really important. Like it is good to have that. That's a hygiene piece from a comms point of view. Like in my experience, why I'm excited to sort of be here and listen is I've been on the front row of businesses having to go through the finance process and recognizing that your brand and your communications can get ahead of that process. So I've been front row, like, Bailey, as you said, like I've seen a business where our brand and comms was well ahead of where the finances and the reality was. So we were I was watching these examples where we'd be talking to potential funders and they'd be looking at the numbers and it wasn't lining up with that story. So alignment is really, really important, I think, if that makes sense.
Yeah. Is there ever any case where strong branding or a strong story can sort of make up for a weaker financial position or the weaker underlying fundamentals?
Yeah, I think it's a good question. I think it does. I honestly, I think it can get you to a place where you can make up for those weaker fundamentals by having time to fix your business in the fundamentals, right? Or maybe get funding in the door. I don't think it will do it. It won't do it permanently, right? And so that's why, I think the alignment is really important. That said, I do think that the communications piece is so critical for a number of things that are potentially intangible in businesses that do go to the balance sheet ultimately. Like I was reminded tonight of the importance of internal communications, right? Like internally, you need to keep that consistent message so you bring all your stakeholders, your employees, along for the journey, right? So that they're not only along the road, but they're also communicating your value prop to market. So anyway.
Excellent. Alex, so you mentioned before when talking about the finances, companies potentially inflating those forecasts. What else are the most common missteps that you see in these companies?
We're trying to access capital. I think so really being able to deliver, so like Jonathan was talking about, if you have been communicating something, particularly in the past, say if an investor or a capital provider is going to look at your board deck from a year ago or 6 months ago, and yes, we appreciate that things change quite a lot, but if they're substantially different, it is going to really create questions. I think we've actually talked before about this analogy of when you're trying to access capital, you're really trying to sell a Ferrari. And that's both something that's sexy on the outside, i.e. what you communicate, but also delivers when you put your foot down. And that's actually underlying fundamentals or the operations of the team or however that goes. So I think those two things, when they're not in tandem, when there is a difference and when they don't keep up, that really creates a lot of problems. Similarly to perhaps what Glenn was talking about before, when the structure of the corporate structure isn't optimal, and there's a lot of kind of sloppy stuff going around that hasn't really been well considered, and it feels like kind of erratic, and it's not really set up with a proper structure. It feels like very sticky taped together, and they really haven't had that quality advisor around them to put something in place that makes sense for the long run and isn't defensible and isn't going to actually last through to achieving the ambitious goal that they're chasing. I think that often, again, means that there's lost confidence in the business, in the team to actually deliver on something that's solid the whole way around, not just providing capital and seeing what comes out.
Okay. So then, Glenn, with the points that Alex just raised, when founders are considering how they're structuring their business, if they don't know whether they're going to exit or scale long term, what are the key things that they should be considering or thinking about?
Yeah, they should consider that. They should consider if the outlook and the scenario changes as well. I think if I look at it again from the founder structure and the corporate structure, putting it into those two buckets and using that example again, if we've got the family trust as the investment vehicle into the business, it allows flexibility or optionality in terms of the founder if their scenario changes. So if there's got a new spouse, if their kids turn 18 and are finally tax useful, it allows it allows us to more flexibility and options in terms of where to send income if there's an exit event, or even if from a more long-term perspective, if dividends are the way we're going to be extracting wealth from this structure. From a corporate perspective, I'd say more often than not, the corporate structure you start with is probably not going to be the corporate structure you finish with. Things change. If your business expands, using my asset protection analogy before, you might be setting up specific entities to hold specific pieces of IP. You might be expanding overseas, in which case you might need to have an international company. Where having a structure similar to where there's a holding company with a lot of subsidiaries makes sense, and it allows you that ability to grow as those needs change. But I think, to Alex's point, it needs to be done with purpose and with planning. Don't sticky tape things together. It needs to make sense, and it needs to be fit for purpose for what you're trying to actually achieve.
And I assume that's all quite relevant to you, Sammy, when you're assessing these businesses as to whether you should, invest or not. Is there anything else in terms of, whether it be founder credibility, that you're also considering when looking at these businesses?
Yeah, it's a really interesting one, just hearing the lender's perspective actually when it comes to forecasts and how much you read into that. I think, again, when you're investing equity in a business, I think that investors often will draw signals from the forecasts you put together as well. Like, I definitely agree, you never want to put anything that seems, almost delusional or unrealistic. Definitely agree. But I think there is an element of, I think investors do look for signals of ambition out of the forecast as well. And so I say that with a caveat being that it has to be grounded in reality. You have to be thinking about top of funnel. What does that mean for how many leads come in? How many salespeople? Do you have enough capital to support that level of revenue? Definitely needs to be grounded in that. But people will also be asking, we're an equity investor. We expect someone to come down the line for a Series A and value the business, maybe 2-3 times more than what it is today. Do you have, the ambition to support that kind of valuation maybe 3 years down the line? So I think that's probably an element there. But yeah, founder credibility, I think, is definitely something we look for. Previous examples of execution, I think, are really important, which is often why second-time founders who have had an exit before are very, very favourable, particularly in this market. And I think there are also certain elements of, don't also say that you have a level of revenue that during legal diligence will be proven incorrect pretty quickly, because I think that's a worse signal than having less revenue right now. I think there's a lot of sort of implicit signals that we derive in terms of founder credibility.
Can I just add something to that? Because you got me thinking about the founder story, because that's something that we've done a fair bit with, and I've witnessed it firsthand, and I've witnessed it in the context of fundraising. And I think it goes to the question of, yes, you have to have these fundamentals, but you also need, I think, people feel that a founder will get the job done, right? And it's almost an intangible, I think. I'm not sure if you've seen that, but I've seen it firsthand. And if you try to capture that in the story, but then that person has to be able to embody that story when they go into these meetings, right? When, and again, it's an intangible, but it's something like the person will find a way through. They will find a way to make something work, because there are going to be these obstacles on the journey. They're inevitable, and they're going to be shocks and potential cash crunches and all of this. But the person has to go, I believe in this vision. And so that's where mission and vision, I think, they don't have to be ambitiously crazy missions or visions, but they have to be something that I think oftentimes inspires other people. But again, borne out and supported by what's under the hood. I like the Ferrari analogy a lot.
So I assume a lot of I guess founders are taking the same approach though. They're all trying to seem inspired because they're all chasing the same money. How do you see founders setting themselves apart from others, and how do they make themselves stand out to really increase their chance of getting that investment they're after?
Oh, yeah, sorry, I feel greedy. I jumped in before my question there, but I listen. Like I think you need to listen to what the team or the founder or the technology or whatever they are, what they're actually doing, right? So I wouldn't advocate that. With most companies, they'll say, oh, well, it's like some kind of greenfields thing, right? Like no one else is doing it. I don't believe that. I studied invention, just I did a research project in invention. There's so much co-invention that's happening, simultaneous invention all the time. And it's actually uncanny. Sometimes, people around different places never hearing of each other inventing the same thing. So the standing out part is a difficult one. And you will often have a competitor. But I think if in telling the story or figuring it out, you listen to what the key differences are, either in the technology and the people and the team, in what they want to do with the tech, and then you capture that, and then you communicate that widely, and then you keep repeating it. So something that I find that's interesting with people who are entrepreneurial in nature is that they oftentimes get they get distracted by the next bright, shiny thing. I think it's similar to what, Alex, you were saying about the next year they come back with a different story, right? And it's really important not to. It's important to kind of stick to where you've landed and kind of keep telling that story until the whole world knows it.
Sammy, does that align with what you see in sort of standout founders that you assess and want to back?
Yeah, definitely. I think obsession with a problem is probably the best thing that we see. And I think people who really deeply understand the commercial model of the industry they work in, I think that is a major, major green flag in a lot of the companies we look at. Oftentimes, not oftentimes, in every single case, the founder knows more about an industry than we do. And I think the ones who are able to convey really, really well, every single stakeholder, what their incentives are, the economic value that they care about, I think those founders are absolute standout. And yeah, like Jonathan mentioned, I think having a sense of realism around the competitor set, the fact that there are probably going to be thousands of other people who are probably building something quite similar, but being able to articulate pretty clearly what differentiates you and what you're building, I think that's a standout as well.
Is there like a set formula for companies who are often successful? If there was, say, 3 things that they all do right, what would those be?
I think I wish there was a set formula. I think that'd be very cool. But no, it's a good question. If I think about like our portfolio and some of the great founders that we've seen, I think they always bias towards executing, definitely. Sometimes you can get the visionary founder who I think gets really caught up in what's next and what the future of an industry is. And I think there is definitely a place for that. And it's an important quality to have, but those who kind of continuously just go after the customer and try and figure out every problem they have in any way, I think that's always a really great sign. I think, I guess, in terms of the conversation we've been having today, those who understand like the fundamental way to make money in the company, I think that's really important as well. Like early on, I think you can chase opportunities that at a unit economic level probably aren't really viable. And I think the founders who are pretty quick to understand where the money's coming from and go after the right opportunities, that tends to be a good sign as well.
So Alex, when it comes to raising capital, just backing off what Sammy said, what does a good position look like when you're assessing a company to say, okay, we believe in this?
It comes down to, from a lender's perspective, I can talk. It's probably perhaps different from an equity investor's perspective. But we like to see things that make sense. And by sense, I mean, are you allocating capital within the company in a way that generates some sort of return or is likely to generate some sort of return at some foreseeable point in the future? So we see people who have raised equity capital then go and hire a huge amount of people, and how rapidly they do that can often not make sense for the stage the business is at. And then, you can see down the line that actually hasn't delivered and put them in a tighter spot and therefore has been kind of counterproductive. That's probably the biggest one, actually. So yeah, what actually comes through is it actually doesn't seem to make sense. And again, speaks to kind of how those founders and the management team really operates, and it just flows all the way down the line.
So Glenn, we were talking earlier around how the story can sort of get ahead of the numbers. What can sort of either a financial advisor or an accountant or any advisor behind the scenes be doing to make sure that there's nothing misleading or sort of anything going on bad behind the scenes?
Yeah, well, clients are relying on our advice or our information we're providing to tell that story. So obviously at a fundamental level, we need to make sure that the advice and information we're giving is accurate, needs to be timely. Like accounting firms, we're need to be compliant with professional standards, so we need to make sure that we're acting in accordance with those. I think it's actually important that advisors know when they're out of their depth a lot of the time. So you don't want to say yes and figure it out later. What you want to know is where's your limit, and then do you have resources within your network to pull in to help get that result for your client.
Okay. So let's say a company's ticking all the boxes in terms of, on the finance front, the branding, the fundamentals or the structure. What we often see with our clients is that they're very late to the party in either seeking lender funding or external investment. Sammy, from your perspective, how early is too early to be start building those investor connections or relationships, or even just looking what's out there in the market?
Yeah, very good question. I mean, we've had examples of portfolio companies that we've seen 12 months before we invested in them, and we continuously just kept the conversation going. We may be, I think we even passed probably 3 or 4 times before we ended up investing. So I think there's definitely value in starting the conversation early. I think what ends up being more valuable is if you start the conversation early, you as a founder are able to qualify out the investors who aren't really well suited to your business. And I think that tends to be a good way to do it. If maybe 12 to 18 months before you think about raising, if you start having the conversation, you get a sense of the kind of businesses different funds invest in. I think what's really important as well is knowing the kind of exit outcomes different funds expect as well. You might have a multi-stage fund that expects to continue to put capital into a business and get a pretty large outcome versus smaller funds like ours, which are probably more aiming for an outcome in the $100 to $500 million range. And I think that definitely impacts the way that you think about building and exiting your company. And so what you can do pretty early on is figure out who is right for the kind of company you're building, who isn't, and then when it comes time to raise, you pick a handful of investors that you run a really tight competitive process with, and it tends to be a good way to kind of preserve your time and energy when it really matters.
Okay. So if I'm a founder looking for an investor, what should I be considering when I want to choose the right investor for my business? I'd say number one is the kind of involvement that you want. So some people really like it when a VC fund leaves them alone, and I think that makes a lot of sense. And so you definitely, in that case, would want funds that are probably making a lot more investments at the early stage versus, again, like Tidal. I think we tend to find we're pretty active and involved. We don't make many investments, and so some people really like that, and they like the kind of operational expertise that the fund has. So that's definitely a part of it. And number two, like I mentioned earlier, is the exit outcome that you're after. If you're looking to kind of make really good money, but 3 to 5 years in versus being in it for the long haul, 10, 15 years plus, I think you probably want to be selecting who you go after pretty early on from that perspective. And then I think that there's probably a lot of nuances around the kind of expertise you're after. So some funds are very specialist funds, particularly, they might get cybersecurity really, really well, and you want people who have good networks in that kind of area. And so you'd probably want to go after someone that has that versus more generalist funds. So Alex, when you're sort of assessing a company to lend to them and they haven't really thought through their funding gaps and they're sort of, last minute, we need some money. How do you normally approach that sort of situation?
Yeah, I guess there are times when we can be flexible and times when we can't. All lenders have, what's called a credit policy. There's certain guidelines and parameters that they can and can't work with, as well as a kind of philosophy, as well as the kind of company they work with. So, us, we're not a last resort lender. So when companies are dead out of money or they're about to be, we can't work with that. In saying that, we often operate as a kind of bridge between now and an imminent funding round. And so in those cases, we'll essentially understand, like, what is your demonstrated ability to pull off what you're going to try and pull off, and how much confidence do we have in that? And for us as a lender, we'll try and figure out, all right, well, what does a downside scenario look like? And if we can get confidence that, all right, yep, it seems like a reasonable plan, it seems like a pretty strong team that are going to be able to execute on what they need to do. And internally, completely aside from the business we're talking to, can we make sure that we limit our downside too? Then okay, we can work through that. We can support the company through that slightly hairier time. It's actually kind of rare that we find companies being super proactive and they've got close to 12 months worth of runway with the capital that we provide them. It does happen, but oftentimes we work with companies that are closer to 6 months runway. And they're working towards some larger or more kind of longer term capital event.
What would be the key difference, do you see, with a company who has a solid plan in place, they know where they're going, where they're going to get money from, versus a company who is just, I need money now for something and I don't really have a long-term plan? What do you see the benefits of having that plan being?
So the long-term plan, to be honest, doesn't come into our kind of realm as a massive factor because we're often working with a short-term loan. But in saying that, it does speak to, again, like the quality of the people that are operating the business that you're providing capital to. So yeah, if we can see that they're making super short-term decisions that don't seem to make sense, they can't really explain it, then we will be reluctant to provide capital in that situation. It happens rarely. I mean, a lot of these companies that are getting to these stages where they are trying to access capital from a lender, they've actually, already for the last few years been out there demonstrating they can, pull something off that's pretty impressive. They can operate a business. They can hire people reasonably, and that kind of thing. So it is rare that we see people that are super scrappy. Like they're probably not going to get to the point where they can actually access any money from any investors outside of kind of very close friends or family to pull something off. Yeah.
Jonathan, what advice would you give to investors or to founders, who want to be investment ready? So even if they're not seeking capital right away or it's sort of in the next few years in their pipeline, what advice would you give to them?
Yeah, well, I mean, just listening to you guys, has got me. I was thinking about the various experiences I've had on kind of both sides of the table, like either advising or even seeking capital. And I think to your point, earlier is better, right? So right from day one, I think your story, whether you're going to be seeking capital or not, whether you're going to want investors or not, I'm just thinking, we work with a lot of deep tech, right? There might be immediate need for investors, or there might be none, right? They might have already banked something, and then they're just going, we're going quiet. And there might not be need for PR generally for a while. But it's always about cash, right? It's always about the potential cash crunch that someone's going to face, right? So I've been on the side of the table where there's been a cash crunch. It is really unpleasant. And when you've had one, you explain it to people in the community who've also had it, and they're like, oh my God, right? And in this environment in Australia, there's a lot of risk aversion, like I think maybe than in other markets, larger markets. And so I think it helps, right, to first start building those personal relationships and demystify the investment process, like demystify the debt process and the equity process and the accounting process. Just become familiar with it. That would be the biggest lesson that I've taken away kind of in my time and working with founders, is that just make it a part of what you're going to be doing, right? Then from a story point of view, you build a story that's robust enough, broad enough, will be able to move through the years, and not with major changes, because maybe a corporate structure changes. It shouldn't change the structure necessarily of the story or the brand. Those would be the main points. The other thing that I think it's worth talking about, given the rise of LLMs and our AI and what have you in our business, what we're seeing a lot of is that people in search, right? They're having conversations with their ChatGPT, right? So before they talk to you, they're talking to ChatGPT. And what's quite interesting is, whereas in the past, say we scored some high PR tier 1 piece, right, in the Fin Review or Wall Street Journal or something, right? People would, kind of have to island hop, do their research and island hop, right, between all these different sources of information, which is, you guys also do research too, right, obviously. And that's not what's happening now, right? Now what's happening is there's an aggregation that's happening. So that your conversation with your ChatGPT, you're getting, a picture of the company, a picture of the founder, maybe a picture of the category that they're trying to kill, right? So, we've been amazed at how quickly we can, I wouldn't say manipulate, but inform or educate the LLMs around what type of conversation maybe they want to be having around these companies. So there's something to think about, the importance of story from day one as a readiness strategy. And also just talking to investors. And one last thing, sorry, but there's a lot of family and friends piece, and I think you mentioned the cap table as being sometimes scary, and we've seen that too. And sometimes when there are too many people on the cap table, it influences the brand and the story and what you can and can't do. So, yeah.
So we'll just go one more question before we jump to the audience. Going back to Alex's Ferrari analogy, so it has to look sexy, sound good, run perfectly. What's often the missing piece? Anyone wants to?
I'll start. Well, in that analogy, you could think of the founder as the driver. I mean, they drive the car really well, sometimes a little bit too fast. Off they go. Yeah. I set that up. Yeah. I would think, if we call it an F1 Ferrari car, they need a pit crew, right? So the advisors that they surround themselves with are the pit crew. The founder's good at what they're good at, but they need to know what they're not good at as well, and fill those gaps with the advisors, is what I think.
Yeah, I'll actually say, this is a lot of what we've been talking about, but when you're trying to access capital, you're convincing someone that it's a smart decision. And a lot of that actually does come through communication. Sammy and I are sitting on this side of the table trying to understand your business, which is probably operating in some niche because that's where the opportunity is. We've never heard of the industry, let alone sub-industry, let alone the niche opportunity you're trying to solve. So the communication point actually really, really helps. It helps us understand and therefore gain confidence in the kind of realm we're about to be working with. Yeah.
Oh, yeah. Yeah, I'm happy to go. I think of the Ferrari analogy, obviously performance I think is king. I don't know, would everyone agree? But I think at least from a VC investor's perspective, I think the biggest thing is if the business has been underperforming, the story behind why now is the right time to invest and what is the catalyst and what's about to change, I think can massively impact how things turn out. Because I think it's the reality that things go wrong and you pivot or you run out of money, and I think challenges are obviously part of the course. But if you have a reason why suddenly we feel like the product's at a stage where it's about to take off, or we've unlocked this particular insight in the market, I think that can go a long way in, as Alex said, convincing someone to really be bought into the vision and why suddenly right now is the right time.
Yeah, no, I was just thinking as you were saying that about the story and why, because that's the big question, why do you need the money? And it's because you've been driving too fast and your hair is on fire, the car isn't and that's the story you don't want to hear, right? I think it goes to this founder question too. Like, I think the thing I've observed is that the founder, there's a balance between the founder knowing they need to seek advice, right? And then maybe seeking too much advice and getting too many different, like it's good to have trusted advisors, so but it's also the founder who thinks they can do everything scares me, right? The person who goes, it's just marketing, it's just comms, it's just, just numbers, like that scares me. But I do think getting too much advice, there can be advice overload. So that's why the trusted advisor piece, I think, is really critical. And I'd like to see that. So when we're working with companies, if I see that they sort of have this balance and they know where, and they also experience, like what you've said, like they've had one or two, maybe startups that can help. They understand the process a little bit.
Awesome. Well, thanks so much, everyone. I think we'll throw to the audience for questions now, if anyone has any.
Thanks a lot. Michael Kelly's my name. Alex, Jonathan, what's a mistake you've made in your career as a founder, and what did you learn from it?
Oh, I'm holding the mic, so I got to go first. That's scary. I've made a lot of mistakes, and I haven't always learned my lesson. The biggest lesson, I think, it does have to do with cash crunch. One of the businesses we were overseeing and had, occasionally we take equity in businesses that we like or we believe in. And so this particular business had very good revenue, about $4 million a year, but the cash management piece was very poor, and there was a funding gap. And the biggest lesson I took from that, I took two actually, was there has to be a fierceness in solving problems that's baked into the culture of the business, I think. But the second thing is, do not wait too long. Like, get your house in order, know where you're going, and have those conversations way early before you ever think you need them. Because your ego can get in the way, and your sense of mission and your sense of brand, those things seem to get in the way at times.
Ironically, mine is not taking enough calculated risks. And so I think I've naturally and my co-founder, we're both naturally more risk averse, probably, despite us both jumping into founding roles. But I think over time, we found ourselves getting some momentum, and that was great, and what we were doing was working, et cetera, et cetera. So just keep doing what you're doing. But throughout that time, we've missed opportunities because we've failed to take a bet on something. And whether that's experimenting with some new promotional activity or a different way of operating or a different kind of product feature or something like that. Because we thought, that's relatively costly, or it's going to take up too much of our time from here, or we've just got so much opportunity cost because we've got finite amount of time and we're spending over here, which we know is working. And so I think over time, we've started to realize that, okay, once things are moving in your direction, you've got your kind of core gemstone, real flywheel in the business starting to move, it is time and it is important to experiment in a calculated way, but be willing to spend a bit of money on an experiment. Make sure you actually watch what the return and what the learnings were from that. But often people either do it too much and they do it erratically and they're not really doing it in a considered way, or like us, they didn't do it enough at all.
Hi, it's James Kemp here. Firstly, I've wrote a load of questions down. You've answered a whole stack of them, so well done. Thanks, really interesting. Probably Jonathan and Sammy, you've both talked about kind of almost this picture of interviewing a founder, and there's this sort of judgment call that you make. This sort of that question around having enough advisors around, but is it too many advisors? How do you quantify that qualitative aspect? And trying, because you're in an industry where, picking also from Alex's point, where you're talking to someone that is the expert in the industry, but you're not. So I'm kind of interested in how you convert that kind of gut feel into some form of quantitative assessment.
Okay, so I'm looking forward to hearing what you say, because I don't know if I wouldn't say, I'm largely qualitative. We have quantitative elements in our business for sure, and analysis and what have you. But in terms of that founder piece, I think just one thing, just rule of thumb, is that person who's constantly changing, like they meet someone and then they change their mind based on that. Then they meet someone else, in the next moment. That concerns me when I see that type of very rapid fire pivoting, or they keep meeting their own new ideas and they keep pivoting there. I worry about that. So that's because it will directly go to my ability and our team's ability to shape a coherent and sustainable narrative, or not just a narrative, but presentations, et cetera. There'll be this kind of seagull management piece that comes in where the person will be dropping in and change, nothing will be right, et cetera. And then it's our reputation to put someone out into media, right? And there needs to be coherence. So yeah, that's on my end. And that clearly will go to the business model and probably the success of the business as well.
Sorry, James, is your question, how do you determine?
You're talking about stuff that you're interviewing, and it's almost like this gut feel. And I'm going, how do you validate that gut feel? Yeah. How do you quantify that gut feel so that you then turn around and go, we should invest in this company because, not just because I got a gut feel. Here's the quantitative assessment of that.
Yeah, I'd say quantitative assessment at our stage is really difficult. Because often, the best way to see that is just through the numbers, and you have customers that are paying you, $1 million, 100,000, whatever it might be. At our stage, we index really heavily on different signals. So I think the first thing we do is we interview as many experts as we possibly can in the industry, because as you said, we know the least about it in that particular scenario. So we speak to customers, we speak to stakeholders who are somewhat adjacent or related to the industry, and try and get a sense of whether we can validate the solution that they're building, both from a technical perspective, but more importantly from a commercial perspective, whether it's something that the market wants. I'd say that we pick up on signals of founder execution as well. Like I mentioned earlier, we'll interview previous people that they've worked with. We try and get a sense of just even really simple things like the speed of follow-up, how thoughtful they are in the way that they articulate a vision. And then I think the other big part of it is just where we can, we try and put the product in the hands of portfolio companies and people that we trust, and just try and get real world feedback of how they work with it.
I'm interested in your sway or influence around particular markets, particularly here in Australia. So, it's in the tech industry, we're really interested in it, but if you broaden it, so influence around education sector, or it's the mining sector, how much does the actual sector that you're selling into influence you? And once again, how do you make that assessment?
I'll take that one. Yeah, it's a really good question. Again, probably it's interesting how much the fund that you're speaking to will index on certain industries as well. So bigger funds obviously are after a larger TAM. I'd say smaller funds like us, Alex mentioned it before, but we love really niche industries and really niche applications of technology, where we expect that all of our businesses are global from day one, and so we aren't particularly, precious about what industry in particular you're in. I'd say that there are certain industries where Australia is a really good launch pad for technology. Mining is a great example of that. There's recently been a very successful kind of exit in that industry in Australia as well. Education we find is a hard one because it tends to be quite localized in terms of the product that's being built, but anything with global applicability, I think we're big fans of.
Sorry, just to follow up on that.
Sorry, thank you.
Sorry, just to follow up on that one, and I think it was raised earlier as well around where specific private equity players or venture capital players have specific expertise in an industry and know that they can add immediate value and help grow that business purely because of the experience and the expertise that they have in that industry. Are there specific industries that you target where you know that we've got specific already expertise, we don't need to pay external providers or pay external expertise to bring in, that you can bring that expertise immediately to that business and bring the value with you?
Yeah, it's a very good question. If I speak for Tidal in particular, one of our managing partners was previously the head of product at Confluence. He was a CTO and he was a co-founder twice and exited both those companies really successfully. He understands product, pricing, and packaging exceptionally well. So I think any business we see where we can see Tidal having like a decent amount of value post-investment, I think we tend to favour those. Anything where, it's somewhat dev tool related or product tooling related, I think we tend to really like. And then equally, I think broadly, I'd say any fund seems to focus heavily where they've had previous successes. So if you're talking to a fund that's had a really successful ed tech exit, in the last few years, they'll tend to double down a lot of the time.
Hey, Bailey, Alex, Glenn, Sammy, and Jono. So all 5 of you work quite closely with early stage companies to help them grow. If there is one piece of advice you could give to companies that you work with in the early stage to make it easier for you to help them, what would that piece of advice be?
If I tell you to do something, please just do it. Probably as simple as that.
Funnily enough, I'll just speak to my experience as a founder, going from day zero. Surrounding yourself with people who can give advice. I think, mine and my co-founder's experience, we very early on spoke to a lot of people in our and adjacent industries or who had some experience building a business successfully, unsuccessfully, whatever it was. We just went and met so many people, listened a lot, asked 1,000 questions, and ultimately we found people who we really gelled with, who were really interested in what we were doing, who wanted to get involved to some degree, and ultimately who wanted to put their money where their mouth is, not just offer some advice for a bit of a stake in the company. And as a result, we built a really solid, unofficial advisory team around us who are shareholders and therefore actually care about what happens to the company. And that has proven invaluable. From really, really key introductions to people who allowed us to make kind of step changes in the business, through to financial support when we really needed it. Through to advice through novel situations, because as a first-time founder, everything's bloody novel. And that, literally made all the difference. And those are the people who will probably, as the business starts to mature and you start to know much more about your space than those people from the effectively outside, they start to move away, but always still are there for even just a mentoring conversation. And obviously as a founder, you go through some hairy times and it's very volatile and the roller coaster is real. And so finding someone who can kind of calm you down and help you think about things or challenge you to think about things in your own way to navigate that is incredibly valuable.
If I could put it down to one thing, try to plan ahead. If there's a problem that you can see, let's deal with it. I think, Jonathan, you were saying something similar earlier. It's better to deal with a problem or fix something before it's an issue rather than dealing with it when we're already in a crisis. I think that would be my tip.
I'd probably say think about the life that you want and the kind of business you want to create, and then I guess right size funding to that. I think a lot of the companies we meet are really, really amazing businesses, but really don't need to be raising venture capital either. And so I'd probably say think about how you want to build a business and whether you really have to do this in order to get there.
First of all, every single piece of advice there, I want to grab that. It was all really good. And Alex, in particular, I was saying, you said you were risk averse, but it's interesting what you described in terms of that advisory group, that official, is actually it takes a lot of courage to build those, to reach out to people, ask for help and mentoring. So I think that's something I would double down on. But my piece of advice is that because this goes without fail. Right from the beginning of starting Andiron, goes without fail. Every startup, every scale up, everything is, no matter what it is, a founder needs to know it's going to take longer than they think. So a tech implementation, a new partnership, a new customer, the number of times that people have come to us and gone, okay, we just landed this customer, right? This is going to happen, especially if it's government, right? It's like if someone's saying, oh, it's going to be done in a month, it's going to be done in 6 months. So that's a really, because if you set that threshold, then maybe you set a better pace, better cadence, sort of expectations around what's going to happen.
Hi, Peter Zelek's my name, Dimension 5 Design Architects. Thank you, all of you guys. You've made some really good points. One of the ones I want to ask you about is you need investment to grow a business. So you've got a business to start it up, you've got some foundations and you want to take the next step in growing that business. You have to invest, you have to market. When you look at a business, is there a percentage of a business you say 20, 30% you've now got to reach to start marketing for that next stage of growth? Investment in advice, investment in group meetings, as you said, Alex, and yourself, Jonathan. Is there a formula or is there a percentage you would say, look, a good business would need to do this amount in investing for their future growth? Maybe, Glenn, you might be the person to answer that. I don't know.
I don't think there's a rule of thumb. I mean, in the space that a lot of my clients are in, where there are that high growth clients that are actively developing their product, 100% of their cash goes into the development because they're pre-revenue clients. So then that mix definitely changes as the business goes through its cycle. So I think it's hard to pinpoint a specific amount. I think it really comes down to your objectives, where you're trying to get to with your business. Do you want to grow? Are you happy with the level that it's at? I think it's definitely a case-by-case thing. And any thoughts?
Yeah, it's such a dynamic thing. There are so many moving pieces which influence at what point is the right point to make some decision or spend some resource. I think we always take the approach of try and stay just one step ahead of that point in time. If you feel you need a new person for this thing, do you need them now? If so, it's probably too late to have made that decision, because it's going to take 3 months to find the right person and then another month for them to start and whatever, and get their feet on the table, and then they're only adding value kind of 12 months later. So I think how we kind of approach it is we feel something happening. We're always being slightly paranoid or attentive to some signal that we've picked up out there. And we check ourselves as, is this a real problem? Is it something that's significant? Do we need to address it now? When is it likely to materialize into something that's significant? And therefore we can figure out how much lead time we have to solve that thing, or if it's just noise and we don't actually need to worry about it. And then I guess that's kind of like the reactive way. And then the proactive way is, well, what do we actually want to achieve at what point in time? What's required to actually achieve that, do we think, and kind of reverse engineer it from there. But again, it's just so dependent on the style of the founders, what kind of resource they have available to them, what kind of goal they have in terms of, like, are they actually willing to give away some part of their business to raise some equity investment to then spend on this goal, or is the person or the people that owns the business, do they actually want to keep more of it, and therefore you have to rely on free cash flow to actually invest in these things. And therefore, okay, well, if that's the goal and the strategy, then at what point in time do we have that free cash flow available to then allocate to these certain things and prioritize probably?
From an accounting perspective, there's a lot of talk of structuring and etc. Is there a particular structure that works for most founders for most scenarios, whether they're going to seek private equity investment, or whether they're going to seek new shareholders, or whether they're going to seek to exit? They want to keep their flexibility. Is there a particular structure that you advise moving to sooner rather than later, or is it always super dependent on industry, personal financial situation, et cetera, et cetera.
Yeah, if we're talking an investment vehicle for the founder into the business, I've used the example a few times tonight where probably 99% of the time I'm going to recommend that client invest via a discretionary trust to give them the flexibility of how to stream income out. If we want to talk tax, I'd love to talk more tax tonight if we can. Yeah, so I think a discretionary trust tends to fit a lot of founders. If it's like a single founder going into a company, that would be the way that I'll go. If there's a group of investors, I think it's been mentioned by Sammy that we want to keep the cap table clean in a lot of cases. So there might be an investment vehicle to invest in where a lot of other shareholders might be investing into, so that there's only one direct investor into the operating company that will be then raising capital. So I think those are the two common ones. In terms of the business itself, generally I think we're all talking about companies as the ideal way to operate your business, more often than not, yeah.
Glenn, can I ask, actually, we often see a triangle model where you have a head co, you have an IP co, and you have an operating co. Can I ask, what's the rationale behind that?
Primarily asset protection. It's pretty. We would generally not recommend that a business have their assets, mainly being IP, in the same entity that's operating the business, because the business inherently has a lot of risk, either from creditors or employees. If you're not adequately insured, for example, what you want to try and do by separating the structure like that is to, I guess, quarantine any damage that could occur in the operating company, which has no valuable assets. So, in an example like that, that company gets wound up, but your valuable assets still protected outside of there, and then you can start again or start a new operating company without that sort of the legal issues ongoing.
I'll throw in another question because we're all keen for some free advice on the tax side. We often see companies with that kind of structure or multiple entities. Some are consolidated for tax purposes, some are not. How might you think through that?
From a tax efficiency perspective, I would tend to think ideally it would be consolidated for tax. I mean, generally speaking, there's reasons why it wouldn't be, but to get to that outcome, ideally you consolidate early in the piece, because there can be some tax consequences of consolidating later on when there have been activities or an increase in value of assets or retained earnings accumulated in the company. So it tends to make sense from a tax perspective, because you can transfer those assets from one entity to another entity if you need to, without triggering any adverse tax implications.
Sorry, I do have one more question. You chatted long enough for me to come up with one more. I'm interested in your perceptions as investors. You got this founder, and the founder's so passionate about their business that they put their house on the line. Right? They pumped everything they've got. They put everything on the line, as opposed to investors passionate about it, but he's protected his own personal assets and his house is not on the line. I'm curious to know, is that getting into any play? How would you interpret those things? Because you've got two different stories there.
So conviction's one thing, and that certainly represents conviction. But at the same time, the founder journey is such a volatile one and requires such persistence and underlying security, really, that I think what we actually see in the companies we take a look at is those that were actually able just to survive the first couple of years of darkness were able to then pick up the pieces, the breadcrumbs, to ultimately figure out what real solution is worth solving and are people going to pay for. So many people don't start, the idea that they start with, or the theory they start with, the solution, isn't what they end with. And that's because despite them being an expert in the field, their initial hypothesis is, often needs some work. And that takes time, it takes money to get there. So when the founders do have a kind of, they don't have a massive mortgage to be paying off every month. They can afford to, take a low salary or they can afford to weather the storm, I actually think that ends up being a kind of key success factor. Yeah.
Can I just add to that? I think that monetary desperation, there's an element there. It can really impact thinking. It can narrow your thinking, and can lead to some bad choices. And I would definitely second, even from a story point of view, getting the fundamentals right at first. But again, you're going to adapt. You're going to change. You're likely, as an expert, going to be learning in that period. And you might not want to put your head above the parapet, either putting your house online or putting your story out there too publicly, and sometimes keeping your day job.
So thank you, everyone. Thank you for your questions. It was really good. And I think just to wrap up, if each of you guys could give us just a key takeaway or a snappy one-liner, advice that you'd give to founders who are preparing for their next stage of growth that will, stick in the memories of everyone here for all of eternity.
Be smart with your decision making when it comes to accessing capital. Think long term. Think quickly, and get others around you to help you think quickly.
I'm just waiting to see if the car comes back. Yeah. Would have been perfect from Vroom. I think echoing what a lot of people have said tonight, have the right advisors around you, get the right advice at the right time, I think is definitely important.
I'd probably say that something similar to what I said before, which is about your business and the market better than any investor that you're speaking to, so don't assume any knowledge, and I think, give them a very first principles understanding of what you're building.
I was just thinking, I think it's treat it very seriously, what you're going to be doing or launching, but also treat it like play. Like, I think there has to be a game feeling to it for the creativity and the resilience that you're going to need on the journey.
Well, thank you to our panelists, and thank you to everyone here for coming along. Stick around for food and drinks, and thank you to everyone who also helped set up tonight, to our team and everyone there. So, thank you.